To prove their massive success, Europe's hottest financial tech company pointed to a single, undeniable asset: two bank accounts in the Philippines holding nearly 2 billion euros in pure cash, and then it completely evaporated. There was only one slight problem with those accounts. The banks had never heard of the company, the money was entirely fabricated, and their chief operating officer vanished into thin air to become an international fugitive. To understand how this happened, we have to look at the 2010s. Silicon Valley was dominating the globe with massive tech giants, leaving Europe in a desperate search for its own homegrown champion that could compete on a global scale. In the rush to crown a winner, the traditional rigor of financial due diligence was replaced by a collective desire to see the story succeed. Skepticism wasn't seen as caution, it was treated as an obstacle to progress. Enter Wirecard, a German payment processing company. They presented themselves as the answer to Europe's prayers by handling the invisible plumbing of the internet, moving money directly from a customer's credit card to a merchant's bank account. On paper, the company was a juggernaut. They reported massive double-digit growth every single quarter, and their stock valuation skyrocketed as eager investors poured in. This chart shows the company's ultimate corporate triumph. The flat line represents Commerzbank, a massive historic German institution. The second line represents Wirecard's valuation as it shoots past them, displacing the legacy bank to take a seat on Germany's prestigious DAX 30 index. But if you looked under the hood, the engine was running on pure vibes. Wirecard's foundation relied entirely on the unquestioned momentum of market hype. Curious, if you looked closely at the math, there was a glaring contradiction. Wirecard claimed their European business was doing fine, but their real explosive profits were almost entirely isolated to Asia. They had a complex explanation for this. Because Wirecard lacked the proper licenses to operate in certain Asian countries, they claimed they were outsourcing the actual transaction work to a network of third-party acquiring partners. According to the company, these local partners did the heavy lifting, took a small cut of the revenue, and then parked Wirecard's massive profits in remote trust accounts housed within distant financial institutions in the Philippines. This opaque overseas structure functioned as a shield. It was just complex enough to deter local European investors from asking basic probing questions. The setup was intentionally impenetrable. By wrapping their profits in layers of foreign trustees and third-party jargon, they created a situation where asking for clarification felt like admitting you weren't smart enough to understand the business. During the 1990s dot-com bubble, venture capitalists poured millions into companies simply because they had a catchy domain name. Because Wirecard was labeled fintech, that same fear of missing out overrode basic due diligence. To keep the story alive, Wirecard needed the signatures of its auditors. But the people paid to be the skeptics in the room were operating under a set of incentives that made looking too closely a liability to their own profits. For years, when asked to verify the billions of euros in Asian profits, executives handed the auditors forged bank statements and letters from random trustees. The auditors signed the paperwork anyway. Nobody actually flew to the Philippines to verify the cash existed. Eventually, journalists at the Financial Times started asking a very basic question: where is the actual money? Wirecard went on the immediate offensive, launching lawsuits and hiring private investigators to track the reporters. The company met every inquiry with a wall of aggression. They didn't just deny the allegations, they attempted to destroy the messengers, weaponizing their status as a tech giant to silence anyone who threatened the stock price. And it worked. German financial regulators actively protected the company, filing criminal complaints against the journalists instead of investigating the fraud. The institutions chose to defend a popular lie rather than face an uncomfortable truth. By early 2020, the external pressure became too intense. An independent audit was finally forced upon the company, and this time the auditors demanded undeniable proof directly from the banks in the Philippines. In June 2020, the banks finally responded. They explicitly stated they had no idea who Wirecard was. The accounts didn't exist, and the documents were entirely forged. The money never existed. This chart shows the market reaction. The stock performed a flawless 10-meter dive into concrete, zeroing out and evaporating billions in market value and life savings in a matter of hours. As the walls closed in, Wirecard's chief operating officer, Jan Marsalek, told his colleagues he was flying to Manila to sort out the misunderstanding. Instead, he hopped on a private jet, allegedly flew to Belarus, and vanished. Marsalek was the mastermind behind the Asian third-party network. Nat Invisible Plumbing was actually a shadow empire, built specifically so he could utilize it at the very end to facilitate his own disappearance. The Wirecard collapse reveals a harsh truth about the modern economy. We assume that massive financial watchdogs and government regulators are carefully guarding the system. But when the desire for a success story becomes a matter of regional pride, the people in charge will gladly close their eyes. Financial institutions were outsmarted by simple Photoshop and forged paper, all because they were blinded by the momentum of a rising stock price. Keep a close eye on your investments, because if a tech company claims their wealth is hiding out of sight in a foreign bank account, it is almost certainly already gone. Thanks for watching Irony Economics. If you enjoyed this look into the madness of the markets, hit that like button, subscribe, and let me know in the comments which multi-billion-dollar disaster we should decode next.